What if I told you that you could build some serious wealth with a really simple but powerful investment formula? I'm talking no crazy complexity, no confusion, just a clear blueprint. Well, that's exactly what we're going to do today. We are going to break down the exact four-part strategy one investor used to become financially independent in his 30s. And, that's a direct quote from the guy who created this strategy, John Liang. He didn't just dream this up. He actually used this exact formula to build his own wealth. It's just a perfect example of how keeping things simple and consistent can be incredibly powerful. So today, we're going to walk through his entire blueprint piece by piece. We'll start with a core foundation, then we'll add the tools for diversification, then we'll get to the wealth accelerator, and finally, there's even a little bonus play for the more advanced investors out there. So let's get into it. Okay, first things first. Every strong portfolio needs its solid foundation, right? Think of it like building a house. This is the concrete slab you build everything else on top of. And for this strategy, that foundation is the largest slice of the pie, the entire US stock market. The specific tool for the job is an ETF, and its ticker symbol is VTI. But what does total stock market actually mean? Well, it's not just a handful of the big tech companies you always hear about. We're talking about buying a tiny piece of around 3,500 different US companies. And this really shows you that diversification in action. Yeah, you own the giants, the Apples and Microsofts of the world. But you also own all these mid-sized and smaller up-and-coming companies. The best part? You don't have to try and pick the winners because the winners just naturally rise to the top inside the fund. It's kind of genius. And the performance? Well, it really speaks for itself. An average return of 14% a year over the last decade. I mean, wow. That is the kind of powerful long-term growth that can really build the bedrock of a serious portfolio. Now, for what might be the most crucial point of all. You get all that powerful performance for an unbelievably low cost. That expense ratio, which is just the annual fee you pay, is only 0.03%. It's practically free. And trust me, when you're investing for decades, keeping your fees that low is one of the absolute most important things you can do. Okay, so our foundation is set. It's solid. Now it's time to expand our reach. We're going to add some global diversification to capture growth happening outside the US. And then we're going to add a stabilizing element just to kind of smooth out the ride. Now, I know what you might be thinking. People always say international stocks underperform. And yeah, for the last 15 years or so, that's been true. The US market has been on a tear. But look back at the early 2000s, international was the clear winner then. See? Market leadership rotates. It's like a seesaw. And this is exactly why you diversify. You want to be ready to catch that upside no matter where in the world it happens. But hang on, there's another really cool benefit to going global. Income. An international ETF like VEA currently offers a 2.6% dividend yield. That's a good bit higher than the US market, and it gives you this nice steady stream of cash you can just pour right back in to fuel even more growth. Okay, so we've got our growth engines humming along, but markets, well, they get bumpy. We all know that. That's where bonds come in. Think of them as the portfolio shock absorber. They are designed to provide stability when stocks get a little crazy. And the go-to choice here is BND, the Total Bond Market ETF. Now, at first glance, this number does not look very exciting. I get it. An average return of just 1.8%. You're probably asking yourself, why would I even bother with that? Well, here's the answer. You're looking at the wrong number. You don't own bonds hoping their price will skyrocket. You own them for this number, a surprisingly high 3.77% dividend yield. That is their number one job, to provide consistent, stable income, like a paycheck for your portfolio, no matter what the stock market is doing. All right, our core ETF portfolio is set. Now, let's talk about the accelerator, what our source calls the absolute fastest path to significant wealth for the average person, real estate. See, owning a physical property comes with 4 unique advantages. Let's call them superpowers. First, you've got leverage, the ability to control a huge asset with a relatively small down payment. Then you've got amazing tax benefits. Third is appreciation. The property's value grows over time. And finally, it is a fantastic hedge against inflation, since rents tend to go up right along with the cost of everything else. Now, of course, you can invest in real estate through REITs, which are basically just stock market funds for property. And they're fine. But the choice really comes down to one massive difference: leverage. With a physical property, you have direct ownership and you can use that superpower. With REITs, it's totally passive and easy to buy and sell, but you're missing out on that key wealth accelerating ingredient. So we have our core investments, we have our accelerator, but for those of you who have all that covered and you're ready to take it to the next level, there is a fifth, expert level bonus play. This is an alternative asset called private credit. The easiest way to think about it is, you get to be the bank. You join a fund that lends money directly to big projects, like real estate developers, and in return, you collect some seriously high interest payments. It's kind of like a high-octane bond. It can pay a high interest rate, but your money is locked up for a long time. So what's the catch for those higher potential returns? Well, there's always a catch, right? And it's a big one, the fees. I mean, this slide puts it into perspective. We're going from hundredths of a percent for our core ETFs to a 1.75% management fee plus a 20% incentive fee. We are in a completely different league here. And let me be perfectly clear, this is absolutely not for everyone, not even close. You usually have to be what's called an accredited investor. Your money is locked up for years, and it is a high-risk, high-reward game. This is the kind of thing you only even begin to consider after your core foundation is rock solid. So, after going through all those individual pieces, let's put it all together and take a look at the complete financial blueprint. And here it is, the whole shebang. You've got your US stocks as the core foundation, your international stocks for global diversification, your bonds acting as the shock absorber. Then you've got physical real estate as the wealth accelerator, and finally, that expert level bonus play. See how each piece has its own clear and distinct role? And that really brings us to the most important takeaway from all of this. Building wealth isn't about finding some secret, complicated strategy. The secret is, there is no secret. It's just about having a simple, effective plan and then having the discipline to stick to it. This blueprint provides a powerful and proven path forward. It combines that slow and steady compounding power of the stock market with the accelerating force of real estate. So, now that you have the blueprint, the only question left is, what are you going to build?